This video will provide information on the top 5 investments most beneficial for individuals in their 20s. Do we not all aspire to achieve great wealth and attain financial independence? While it is admirable to possess such determination, given the rapid increase in living expenses, it is crucial to use prudence in allocating your funds. Otherwise, those ambitious financial aspirations may remain unfulfilled. In this video, we will discuss 5 investments that show great potential. It is important to note that beginning one's investment path early can significantly impact. Prepare yourself and appreciate the experience of number 5. Investment vehicles that primarily invest in short-term, low-risk securities, such as treasury bills and commercial paper. 5 money market funds, a type of mutual fund, are considered one of the most secure investment choices. They frequently generate superior returns compared to most conventional bank savings accounts. When searching for an appropriate money market fund, carefully examining the fund's expense ratio is crucial. A lower expenditure ratio often leads to higher returns, which signifies the fund's operational expenses intended for individuals in elevated tax brackets. Tax-exempt money market funds could be a compelling choice considering the significant remuneration. Nevertheless, if you do not expect immediate cash requirements, you may consider investigating treasury bills or bank certificates of deposit, known as CDs. Typically, banks provide certificates of deposit CDs with durations ranging from 3 to 12 months. A disadvantage of treasury bills and certificates of deposit CDs is the considerable transaction costs incurred when withdrawing funds. Furthermore, premature withdrawals from these investments before maturity can result in penalties. However, if you are willing to allocate your funds for the entire duration, both treasury bills and certificates of deposit CDs might provide higher returns than regular savings accounts. However, it is crucial to consider the advantages and disadvantages in light of your financial circumstances and objectives. Have you ever searched on Google using your name and were astonished to discover that your personal information was publicly accessible on one website that discloses personal details? Are you aware that it is possible to conduct a comprehensive search on Google to obtain confidential details on almost anyone? I am referring to personal information such as their residential address, telephone number, and email addresses. Furthermore, it is worth noting that your personal and familial data has also been made available to the public. Data brokers who gather your personal information are profiting greatly by selling this data to robocallers, spammers, and other individuals interested in acquiring knowledge about your residence, shopping habits, and further details. Fortunately, Aura can detect data brokers revealing your personal information and initiate opt-out requests on your behalf. Brokers have a legal obligation to delete your information. Do they intentionally create a problematic situation when you ask them about the problem? Allow Aura to manage it on your behalf. In addition, Aura provides extensive protection against online threats for you and your family. It is not readily apparent that the setup process is quite simple, thereby eliminating the need to download multiple applications for features such as parental controls and antivirus protection. VPN, password management, identity theft, insurance, and other related topics. With AA, you receive a comprehensive package at a reasonable cost, allowing us to handle the challenging duty of ensuring your online safety. This enables you to concentrate on other responsibilities with a sense of security. You can persistently allow someone to exploit or gain financial benefit from your personal information. Alternatively, you can visit Aura.com to commence your 2-week complimentary sample. For bonding, bonds generally yield more significant returns than money market or savings accounts. This is because of the heightened risks associated with bonds. For example, certain corporate bond issuers may fail to repay the borrowed amount fully due to unforeseen financial obstacles. Governments and businesses also own a credit rating like an individual's credit score. Individuals with a lower credit rating typically provide larger yields and carry more significant risks. Conversely, individuals with a lower credit score offer lower returns but are considerably safer. This is a fundamental principle of bond functioning. When purchasing a bond, you effectively loan the entity issuing the bond for a predetermined duration. Typically, These issuers are governmental entities or corporate organizations. In the event of a government default or corporate bankruptcy, there is a possibility that you may not recover your funds. Due to this inherent risk, bonds typically provide greater returns, particularly those with lower credit ratings. Jeremy Siegel is the subject of the text. According to a distinguished finance professor at the University of Pennsylvania, who has extensively studied bond performance for 20 years, bond investors generally experience an average yearly return of approximately 4 to 5%. Nevertheless, variables such as inflation and economic recessions can lead to volatility in these returns. For example, if a government bond provides a 4% interest rate and inflation stands at 2%, an investor would ultimately receive a real return of 2% after factoring in inflation. But if inflation unexpectedly increases to 6%, the bond becomes less appealing, and its real return diminishes. In general, long-term bonds offer higher returns than short-term bonds since they include a more significant risk over a lengthy period. Yet it's worth mentioning that longer-term bonds come with their issues. Their credit quality could worsen with time, raising the default risk. Furthermore, they are more vulnerable to the effects of inflation than their shorter-term equivalents. Therefore, although they may provide greater profits, one must carefully evaluate the accompanying hazards. 3. Stocks. Proficiency in finance is not necessary for investing in equities. Stock market investment is accessible to individuals, as it may be done conveniently using mobile devices or computers. By initiating investments in the stock market and continuously allocating your cash to well-established corporations and funds, you have the potential to achieve significant financial gains. Nevertheless, it is crucial to bear in mind that there is no guarantee that every stock or fund you buy will appreciate. Stock returns exhibit more excellent long-term stability compared to bonds. Throughout history, stock returns have shown notable consistency throughout different generations. Since the early 1800s, the U.S. stock market has continuously provided an average yearly return of approximately 6 to 7% above inflation. The constant performance is outstanding, mainly when assessed as an average annual return. However, it is crucial to acknowledge the unpredictable and unstable characteristics of stocks. Occasionally, they may encounter substantial declines, plummeting by as much as 30% or even more within a few periods. Conversely, they can also see sudden and significant increases in value. Furthermore, although analyzing the stock market's historical performance can offer valuable information, it is crucial to approach future investments with thorough research and prudence, considering that market dynamics might change. Now that you know this, let's delve into how to generate profits from the stock market. There are two primary approaches to achieving success in the stock market. It is advisable to adhere to two fundamental principles to get optimal results in investing. Firstly, maintain a consistent and regular investment pattern. Secondly, adopt a long-term perspective. Additionally, it is recommended to diversify your investments globally rather than focusing solely on one country. This approach helps to mitigate risks and often yields higher returns on your investment. However, similar to any investment, there are potential drawbacks. It can be alluring to hastily invest in the most popular stocks or industries currently being discussed, but this approach should be avoided. Engaging in activities without conducting proper due diligence might pose significant risks. Timing the market accurately can be challenging, as it is difficult to determine if one entered early or late. Consider the example of early investors in companies like Amazon or Google. They are likely enjoying drinks on a luxurious yacht at the moment, but relying on the success of their next venture is not always guaranteed. You may be curious about the process of really visualizing the funds. The correlation is directly linked to the performance of a corporation. If the stock price increases from the point of purchase, you have a profitable investment. However, it is essential to note that the profit, referred to as a capital gain, is only realized upon selling the stock. Additionally, if you have held onto the stock for over a year, you may be eligible for a tax benefit. Conversely, If the stock price experiences a significant decline, you will incur a financial loss. 2. Dividends provide an alternative method of generating income from equities. Dividends are the returns that investors receive for retaining ownership of a stock. Consider it as your portion of the company's earnings. 2. Properties in the real estate sector. Although being an experienced investor is not a prerequisite for real estate success, approaching it as a small business might be advantageous. This entails attending to the needs of renters, overseeing financial outlays, and maintaining a competitive edge. The 2008 global financial crisis resulted in a worldwide decrease in real estate prices, creating the perception that investing in real estate carries significant risks. Nevertheless, real estate remains a resilient and profitable investment over the long term, frequently surpassing the performance of equities and bonds. The surge in real estate investments can be ascribed to economic advancement, employment generation, and demographic expansion. Urban and suburban areas, which are activity centers, generally experience the highest increase in property values. It is crucial to remember that although real estate can be a profitable investment, the main objective of purchasing a home should be for personal use rather than financial gain. 1. Owning your own house. This precludes the possibility of generating rental money but eliminates the need to allocate funds towards rent expenses. Moreover, possessing real estate can instill a feeling of safety and be a significant resource for future financial strategizing. Top-ranked small business. The concept of the American dream frequently evokes establishing a prosperous enterprise from its inception. This dream exemplifies the essence of entrepreneurship and the possible benefits of running a small firm. You can embark on your entrepreneurial expedition by cultivating a strong passion and unwavering determination. Alternatively, if you have the requisite capital and expertise, you might invest in another entrepreneur's venture and gain financial advantages. Nevertheless, it is crucial to comprehend that these undertakings are not devoid of obstacles to prosper. To achieve success, it is necessary to possess a blend of unwavering dedication, demonstrated expertise, and adequate financial resources. Moreover, having a solid and extensive network and a comprehensive market comprehension can significantly augment the likelihood of success in the fiercely competitive commercial environment. That concludes today's session. Thank you for seeing. Have a splendid day, and we look forward to seeing you in the future video.